Have you ever considered how financial models try to simplify the complex world of market movements, especially when pricing options? These sophisticated mathematical frameworks, while incredibly insightful, often relying on certain assumptions that might not perfectly mirror real-world trading. The assumption of continuous trading is a significant limitation of the Black-Scholes model because it presumes that assets can be bought or sold at any instant without friction, which is not true in actual markets. This assumption implies that an options trader can perfectly and continuously adjust their hedge positions to perfectly offset risk, a concept known as delta hedging. The core mechanism behind this limitation is that the Black-Scholes model, as a continuous time model, is built upon continuous stochastic processes, particularly geometric Brownian motion, to describe asset price movements. In such a theoretical world, prices evolve smoothly without gaps, and transactions can occur infinitesimally often, ensuring that any exposure to risk can be immediately neutralized. However, real markets operate with discrete trading intervals, meaning transactions only happen at specific points in time, like when an order is matched on an exchange. This discreteness introduces transaction costs, bid-ask spreads, and liquidity constraints, all of which contradict the model's idealized continuous environment. To practically account for this limitation, traders and analysts often adjust the model or use alternative approaches that better reflected market realities. You can apply the model's insights while also acknowledging that perfect continuous hedging is an ideal, not a practical reality, especially for retail investors or smaller institutions. For instance, instead of assuming infinite rebalancing, consider the practical implications of rebalancing your delta hedge at discrete intervals, such as daily or weekly, and understand the resulting hedging error. This approach helps you to appreciate the inherent risks and costs associated with maintaining a hedged position in a real-world market. Understanding the continuous trading assumption helps explain phenomena like tracking error in dynamic hedging strategies and why transaction costs are a material consideration for options market makers. It also sheds light on why more advanced models, which incorporate jumps or stochastic volatility, were developed to better capture the actual behavior of asset prices and provide a more nuanced valuation. Ultimately, recognizing that continuous trading is an idealized assumption of the Black-Scholes model empowers you to interpret its results more critically and apply its powerful framework with a practical understanding of real-world market frictions and operational challenges.